We are now more overbought on rates than we have been in a very long time. In fact, very rarely do you get this overbought on rates without having rates reverse and go back down. So again, if you've been looking for an opportunity to add bonds to your portfolio, we're getting there. We're starting to push up into important moving averages here, which are resistance. We're extremely overbought. We're still on currently a sell signal. We haven't reversed that just yet. That won't take long to reverse once we start to get a reversal in rates for whatever reason. Here's what you need to know before the bell this morning. A lot of videos running around right now talking about this surge in interest rates and how interest rates are now going higher. The era of low interest rates is over. And we've been through all of this before, and you know, the economic data simply can't support higher rates. We just don't have the economic growth for it. We don't have the underlying infrastructure for it. We have too much debt to support higher rates. So interest rates have to come lower. Doesn't mean, though, that rates are going to come straight down when they start going lower. And again, this is something we've talked about repeatedly. We've written about it numerous times. I just wrote an article recently on the website talking about James Grant's views on interest rates and why he's likely incorrect. It's just because the economic data doesn't support higher rates. It doesn't mean that rates can't go up. And we talked about this 2 days before the FOMC meeting, and that when the FOMC cut rates, that would be a buy the rumor, sell the news moment for bonds. And that's exactly what happened, and bonds have sold off, and we've now had this move up in yields. And of course, that strong employment report on Friday caused a bit of a knee-jerk reaction in yields, and so we've pushed up here a bit. Technically, the reason that we said you couldn't buy bonds back over here when rates were coming down and everybody was dying to get into bonds at this point was because they were extremely oversold. Now, this is a chart of interest rates, okay? So this is the 10-year Treasury yield. This is the inverse of bonds that's going on. So when you're down at the bottom, you're extremely overbought on rates. At the top, you're extremely oversold. So we were extremely overbought on bonds at that point, oversold on rates. And we said, this is why you can't buy bonds. They're going to reverse for some reason. We said specifically back then, something that prints out at a higher rate of inflation or expected to lead to higher inflation, i.e. a strong employment report, would cause that reversal in rates, which is exactly what happened. Importantly now, though, as you know, we've seen, we are now more overbought on rates than we have been in a very long time. In fact, very rarely do you get this overbought on rates without having rates reverse and go back down. So again, if you've been looking for an opportunity to add bonds to your portfolio, we're getting there. We're starting to push up into important moving averages here, which are resistance. We're extremely overbought. We're still on currently a sell signal. We haven't reversed that just yet. That won't take long to reverse once we start to get a reversal in rates for whatever reason. But again, just from a technical basis alone, yields are going to reverse here and they're going to come back down. Now, does that mean that rates are going to reverse here and go to 1%? No, that's not what that means. But we can't sustain 4% rates for very long because it starts to impact economic growth. That refi surge you saw, for instance, in the market, can't sustain that for very long. Right now, the NFIB is borrowing, just their survey came out yesterday, their borrowing rates for small business loans are running near 8%. That's very high for small businesses. So again, that's going to impede things like capital expenditures, which we're already starting to see a big deterioration in CapEx spending, which supports economic growth. So again, high rates are economically deleterious, which is going to lead to slower rates of economic growth. As economic growth rates slow, i.e. so do inflation and interest rates, because they're all tied together. They're all important. They all flow together. In fact, there's a very high correlation between the Fed funds rate and lending rates by banks, which is where rates are tied to. So again, all of this tells you continually that as the Fed cuts rates, rates are going to come down, and you want to use opportunities where you get extremely oversold condition in bonds. That's your opportunity to add bonds to your portfolio. But again, got to kind of set aside all this hysteria about higher rates and they're going to go higher for longer. Just simply economically can't sustain it. That's what you need to know before the bell this morning. All right, a couple of things. What you need to know before the bell this morning. I know you're all probably going, please get to something important.